It's really a great pleasure to be able to meet again for another of our investor briefings. We really thank you all for coming out and braving the traffic. It didn't rain today for most unusual, but traffic seems to have been particularly bad. So the last quarter of 2024 saw a strong recovery in both the US stock and bond markets as the Fed cut interest rates by 100 basis points, and expectations grew that at least another 100 basis points of cuts would follow in 2025. The markets were also buoyed by the victory of Donald Trump in November's presidential election, and 2025 began with much exuberance in the capital markets. Now, all this took place despite the fact that inflation, while trending down, was not yet at the Fed's target of 2%. Unfortunately, the exuberance didn't last for long, because immediately after his inauguration, the new president began threatening to implement very high tariffs on both friend and foe alike. Beginning, in fact, with his two closest trading partners, Canada and Mexico. The almost whimsical way in which the tariffs were announced led to great uncertainty, and both the stock and bond markets fell significantly at the end of the first quarter of 2025. This was just before Liberation Day when he announced these massive tariffs. However, there was a steady recovery in the second quarter because it became clear that the actual tariffs were going to be much lower than the amounts that were initially threatened, even though they would still be much higher than they had been for the last 20 years or more. In fact, tariff levels in the US are now at the highest level since the Great Depression of the 1930s. And they're about 8 times higher than they were before the Trump administration took office. Now, these tariffs will be paid by American consumers and companies, and will therefore have a major impact on the US economy. One immediate effect has been to increase inflation, thus putting further reductions in interest rates on hold for the first 3 quarters of 2025. They've also had a negative impact on the labor market, with unemployment rising slowly and the labor market in the US softening noticeably. As a result of this development, the Federal Reserve is widely expected to reduce interest rates for the first time this year at its meeting next week, even though inflation is still above its 2% target and is actually rising slowly. Now, the full implementation of the new tariff regime began in August, and there's still a great deal of uncertainty as to the eventual rates that will be applied and how they will actually be applied by the customs authorities. However, the costs are substantial, and they're already having a dampening effect on economic activity in the US. A recession is quite likely, and the real question seems to be how long and how prolonged that recession will be. There are other headwinds facing the US economy that relate to the impact on their labor force of the ongoing deportation of migrant labor, and of course possible retaliation against their tariff policy by some of their trading partners. A soft August jobs report in the US has all but guaranteed that the Fed will reduce their benchmark interest rates by 25 basis points next week. However, how much further rates fall in the coming months will depend on the interplay between the softening labor market and the recently rising inflation. Fortunately for us, the bond market has been quite bullish in recent days, pushing up prices and lowering yields. And this has been great news for those who are already invested in the market, and a signal to those who still have funds on the side to invest as soon as they can. Sterling's portfolios have done pretty well this year, as evidenced by the results of Sterling Investments Limited and the growth in our mutual fund. Our capital to total assets ratio is still over 20%, and our capital to risk-weighted assets is well over 30%. And these ratios compare to the statutory minimums of 6% and 10%, respectively. We think that investors will do well to focus on credit quality and duration as they seek to take advantage of future reductions in interest rates. Our panelists this evening will help us to explore what all this means for us here in Jamaica. And we look forward to your questions and comments during the formal proceedings and also afterwards over drinks. So thanks again for coming. Thanks again for the confidence that you've placed in us. And we assure you that we'll continue to serve you with the care and diligence that we've done for the past 25 years. We hope that you find this evening's discussions interesting and hope that you continue to enjoy the evening. Thank you.
Thank you, Trading and Securities at Sterling Asset Management. I have the pleasure of moderating our panel discussion this evening at the investor briefing. I would just like to say a very special welcome to our listeners on Nationwide News, and of course, extend a very warm welcome to everyone who is here in person at the Pegasus this evening. Thanks for joining us, and as Charles said, braving the traffic to come to New Kingston. So for those of you who are new to the event, each year Sterling hosts an investor briefing where we look at a number of things. We try to look at the local economy, what's going on in the global economy, form some assessment of the economic and growth outlook. We also try to figure out how we can get more growth locally, and ultimately, of course, the implications for investors. So you would think that maybe after 20 years of doing this, it would get easier to predict the future, but incidentally, it really doesn't. Particularly in 2025, here we are, globally in the middle of a trade war and heightened geopolitical tensions. Locally, we just had a big election, and economic growth has also been pretty elusive. So we have a lot to talk about this evening, and we'll be delving into these issues under the topic, what trade wars mean for small economies and smart investors. We'll have a 30-minute discussion among the panel, followed by a Q&A from the audience, so please get your questions ready. Now, giving us their best crystal ball insights this evening are our three panelists, and please indulge me for a few minutes while I introduce them. So to my furthest left is Mrs. Valerie Mercer-Blackman, the Regional Economic Advisor for the Caribbean Country Department at the IDB. Valerie is an economist with over 3 decades of experience across many different roles at the Asian Development Bank, the IDB, and the IMF. She has focused extensively on fiscal policy and development strategies across Latin America, the Caribbean, South Asia, and Southeast Asia. So she's very well positioned to participate in our discussion tonight, and we're eager to hear from her. Thanks for being here, Valerie. Now, to her right is, to my immediate left is Mr. Joel Harris, the Marketing Director and Shareholder at Shavuot International. Shavuot is one of Jamaica's leading agro-processing and wellness brands. The company is an exporter of teas, spices, gluten-free flours, and oils. And today, Shavuot sells about 90 to 95% of its products overseas. They reach markets in North America, Europe, the Caribbean, and Australia. So the company is a great model of what export-driven growth looks like. Joel, thanks for joining us. We're excited to hear about your journey and what it means for local policy. Last, but certainly not least, our president and founder, Charles Ross. Charles spent 15 years as a civil engineer building schools and houses and water infrastructure across the island. And then after experiencing his first recession in the construction industry, he realized he needed to get a new job. And he founded Sterling 24 years ago with the goal of bringing safer, higher yielding, and higher quality investments to the region. And in his role as president, the company has generated attractive returns for its investors and shareholders. Valerie, Charles, and Joel, thank you for joining us. Now that we're all acquainted, I'll dive right in. And I'm going to start with perhaps maybe the macroeconomic conversation. So I'll throw this question to Valerie and Charles. I think a popular local enigma that most people, we get asked about quite frequently, is that Jamaica has experienced more than a decade of what the economists call macroeconomic stability, but economic growth has averaged roughly 0.5% over the last 5 years, according to IMF data. So we've had stability, but no growth. Export-driven growth is frequently cited as a concept that could be a solution to this problem. And so, Valerie, I wanted to ask you, based on your experience in Asia and Latin America, what types of policies do these countries maintain that help drive export-driven growth?
Okay, well, thank you very much for the invitation, and wonderful to be here, first of all. So yes, it's of course $1 million question. I want to think about export growth. First of all, think about what does it mean to be able to engineer export growth? What has to be behind that? What are the critical conditions that we have in order to get to that stage? And if you're a firm that is exporting, that means that you were able to be not only competitive enough within your domestic market, but you were able to now compete externally. So, of course, a lot of conditions had to come together. Within the economy, you have, of course, better infrastructure, all the set of conditions that are important. From the macroeconomic stability point of view, which is what we're interested in, I guess one way to think about it is fiscal and monetary policy, what they can do to create that stable environment. In terms of monetary policy, well, of course, if you have high inflation, that creates a lot of instability. It creates noise for investors, and of course, by high inflation, it's going to raise the costs for business. From the point of view of the fiscal policies that you could have, and I just want to sort of step back a little bit. I used to work in Jamaica in 2012 and 2013, and I have really witnessed a miracle. This was at a time when I know the debt management office was barely trying to make ends meet to the next day, and now we're in this wonderful situation. So this fiscal consolidation has created this institutional strength, and sort of has shown the world that Jamaica has gotten to a level in which it can create that macroeconomic stability. And we're at the stage in which we really can start thinking about, okay, now we have some funds that we don't have to use to pay our debt, but actually to invest in the economy. So that setting of the stage towards that level is absolutely essential. And then, of course, you have the types of investments you need, infrastructure, and an environment where even though you will, for example, have to have taxes, where you have a stable tax regime. In other words, the government is not constantly changing taxes or giving some firms more preference to others, or there's an idea that you're going to have, if I have to pay 25% every year, that's it, I pay it, and I can at least have that sort of stability, and that sort of certainty, we should say. And there's a lot of other things, like, for example, trying to promote trade. The government can also have foreign direct investment promotion agencies. Speaking of some of my experience in Latin America and in East Asia, they have been very successful in places like Malaysia, for example, in bringing investors in finding out what it is that investors need, and in making the experience, being a better host, shall we say. So it's foreign investment. So those are some of the things that are needed, I would say.
Thanks, I appreciate that, Valerie. It was good context on investing more in infrastructure and also on the FDI. And I think one of the things that really confounds us about Jamaica is that, so we've had this stability and the fiscal consolidation for some time, and there have been periods in our past where FDI has been, a good percent of GDP, but we still haven't been able to generate growth. Would there be anything on the monetary policy side that you have observed in other countries that may or may not be different to what we're doing here in Jamaica?
On the monetary policy side, again, I think the monetary policy's role in helping, for example, export growth is really just creating an environment of stability. How do you do that? For example, an independent central bank. The central bank has to be focused on making sure that they maintain inflation, that they don't have to suddenly raise interest rates, that they can somehow control the business cycle. So that's something, I mean, it seems like an indirect effect in that they're not directly working, for example, with the investors, but that is absolutely an essential condition. From the point of view of monetary policy. There's also financial stability. We know that the central bank has a role as doing what we call macroprudential policies, which essentially mean ensuring that we don't get into credit booms, that the sort of regulations towards mortgages and other types of loans are being properly done, that there are not too many non-performing loans in the system, right, for example, that could then lead you to a potential financial crisis. So that's a very important part of okay, should we say, the role of the central bank, which is the main monetary policy institution.
Okay, thanks. Charles, would you like to add anything to that?
Well, one thing I'd like to speak to.
Maybe it's not on.
Is the point that Valerie mentioned about inflation. The one thing that's going to drive investors, exporters out of business is higher local inflation than our trading partners. And that's one of the areas in which we have not performed very well in Jamaica. First of all, our stated inflation target is significantly higher than that of our major trading partners. And if you look at the last 5 or 6 years, the cumulative domestic inflation is significantly above the inflation in our major trading partners. And that puts our exporters under tremendous pressure because they don't have pricing power in the global market. And when their costs rise and their income remains the same, that's a recipe for severe challenges and eventual failure. So I think that that's one area where we've definitely failed our exporters, both exporters of services and exporters of goods. And I'm sure Joel would speak to that in the practical terms.
Okay, so that's useful to know because we've been looking at the central bank and thinking that everything is stable because, yes, inflation has been within their range and there's been stability in the financial system, but we have an inflation target that is substantially higher than our trading partners, which is a negative to exporters.
Yeah. You also have to remember that the pandemic brought a spurt of inflation here as well. So there was a period when we were way above the target of 4 to 6%.
Yeah.
So, and that has an impact.
Okay, so that's a great segue, Joel, into maybe your business. You export to the rest of the world. Maybe tell us a bit about your business, what it does, where you export to, who your customers are, and why they buy from you, how you're able to competitively provide a product to them.
Thank you for that introduction, or segue, I should say. So Shavuot International started in 2013 as a farm. And that farm was basically focused on growing Jamaican products, be it Scotch bonnet as being our leader, Jamaican sorrel, sweet potato, sweet peppers, and so forth. And then supply the local market, and then to export through partnerships and trading companies, both to the US, Canada, as well as to Europe, primarily England. That was the establishment of our company, our group of company, and then from there, seeing that we're not able to sustainably farm this produce, given the many different environmental and economical situations. For example, the predatory larcenies that would happen to our farms, the fires that would come randomly from nowhere that would burn our crops to the ground. And of course, the cyclical growth of gluts and surge in prices of raw materials inputs, and even to sell our raw produce, we then had to, if the product wasn't up to standard, then it had to be discarded. So going into the crop, you're thinking that your produce will yield this, but your sales of accepted yield was less or sustainably less than projected. And that to us wasn't a sustainable business model. So then we decided to pivot and to go into value added. And from there, we started in Spanish Town, Winter Spen, basically in a 10 by 10 room, and expanded close to about 10,000 square feet in production. And we then opened a second factory in St. Mary of additional 15,000 square feet in production, basically focusing on one, the nearness to labor, because we work in inner city communities or in the rural community, near to communities. So basically, the people who live right across the road are our workers, right? And we saw the need in investing in these underserved communities so that we can be able to bring empowerment. And empowerment did create economic action, and so their lives generated more prosperity for that community, for those communities as a whole. So that's the basics. So basically, we decided to in-house from farming to manufacturing, packaging, and to shipping. And so we did everything in-house to control the quality, the consistency, and to deliver that to whether it be Jamaica, across the Caribbean, to Europe, or to North America. That has been our focus in that regard.
Okay, and why do you think that your product is competitive globally? How do you get your price? How are you able to offer an attractive price?
Right, okay. So the good thing that our products deals with in teas. Teas are very light to ship. The cost of input compared to other forms of manufacturing, food or otherwise, is not as expensive as the input compared to the value of other products. So in other words, when our products are shipped competitively to the US or to any region that we're shipping to, and it's competitive, that percentage of taxation, especially from us to the US, with that 10% tax, it does hit, but it doesn't hit as hard as compared to other higher valuable products. So in that way, our mill people or export or distributors have been able to take that hit and pass it on to the consumer. And even through that, we have been able to see growth within that market. Why? Because other areas in Asia or wherever that competitive product would have been, has been hit even much further in tariffs than the agreements between Jamaica and the US, for example. The other thing that we use is a product import relief, where raw materials or packaging materials that we import, we're able to reclaim them, so we don't pay taxes or import taxes on that. So things like that has been able to sustainably keep our pricing and our cost structure a bit down. Now, that goes so far and no more, because of course within that, we have to also make sure we're also competitive. So that also means that streamlining our operations, making sure that we're getting rid of waste, making sure we're utilizing every part to make sure we're fully optimal for production. And in that, we have been able to create products for other markets because of that.
Okay, so maybe something that you mentioned, you can claim back the tax you pay on your inputs.
Correct, you're not right.
Right, okay, so that would be pretty accretive in terms of policy.
Correct.
Valerie, does that ring a bell to anything that you've heard before? Are there policies that you've seen that make life easier for these types of businesses?
Well, certainly, for example, for the inputs as well. I mean, we also have to remember that the costs to businesses come from imports, and to the extent that we're going to be possibly seeing higher prices of some of the imports, this is going to be a challenge for those kinds of businesses. Those are issues that are should we say short-term challenges, or depending on the economy of where we are. I mean, it could obviously be much worse, but it can be short-term challenges that have to be put in, and they do affect the competitiveness of the country. We've done some surveys actually on the Caribbean and on Jamaican, and even though the macroeconomic issues came out, some of the bigger concerns had to do, for example, with skills of maybe perhaps not in the tea, for example, in food processing and tea, but labor skills have been very important. There was some mentioning of tax and some tax distortions. It's called the Innovation Firm Performance and Gender Survey that was done by Compete Caribbean. And also tax rates, customs and trade as well are something that have to be contended with. Another thing, for example, in terms of costs, perhaps not in your case, 45% of firms said that the costs of electricity were a big issue. So this is, I think energy is going to be something that that Jamaica can think about becoming more competitive. And we have this new challenge of the energy transition and finding, for example, that some of the renewable energy technologies are actually cheaper than fossil fuel technologies. If you put solar panels now, the gigawatt hour that you can get is actually much cheaper than if you were going to put some other type of fossil fuel type energy. So these kinds of things are opportunities, should we say, for those kinds of businesses. The other issue that was identified, they said only about 25 to 30% of firms identified macroeconomics and digital payments as an issue. That doesn't mean it's not an issue, but at least for the firms that were interviewed, that were surveyed for Jamaica, as obstacles to their growth. So of course there are differences in a lot of the sectors, and one advantage I think that overall that Jamaica has is that unlike manufacturing, which as you know is going to be suffering a lot throughout the world due to automation, due to these sort of changes in global value chains, a lot due to the tariffs that's being imposed by the largest market, the United States, some of the ways in which we can sort of think about changing into other types of areas is really taking advantage of digital services and services in general. And you might think, okay, services are, okay, tourism and the usual ones, business services, but it turns out that all businesses, and I'm sure it's the case for tea, require services. They're embodied in a lot of the manufacturing. For example, you need the advertisers, you need the accountants, you need the logistics helpers, you need the people who do quality control, phytosanitary. All of these things are actually services that are embodied in a lot of the goods. So this is going to be a very important area, and I think a huge opportunity for Jamaica.
Thanks, Valerie. That's an interesting point. Going to the micro of some of what the business people are observing. I just want to, I guess, switch back to the macro briefly. In June 2025, the IMF had published its Article 4 on Jamaica, and they actually indicated that they indicated that the de facto exchange rate regime, they classified it as a crawl-like arrangement. And they also suggested that the BOJ progressively reduced its surrender requirements and lessen the footprint on FX interventions. What I wanted maybe yourself and maybe Charles to try to explain is why is this important to the competitiveness of Jamaica's exports, or how does it relate to the competitiveness of Jamaica's exports? Charles, you could start maybe.
Yep. Well, one of our former central bank governors classified the Jamaican foreign exchange regime as maintaining a subsidized exchange rate. And what that basically means is that we've been maintaining an overvalued currency. And I think the IMF pointed out that the currency was in fact overvalued. And one of the sort of principles that were enunciated when we lifted foreign exchange controls was that we should have a market-determined exchange rate, because in that way the supply and demand, the market can set the exchange rate rather than a bunch of people sitting down in an office somewhere. And for sure, the Bank of Jamaica has this very odd arrangement where they insist on banks and cambios selling them a lot of money, and then they turn around and sell that back into the market at rates that they basically set. And at periods when they decide to do so. So that really it distorts the market. You don't really get a true picture of what's the real value of the currency. And of course, the exporters are subject to periods of really pressure on their competitiveness because the real effective exchange rate is appreciating.
So the IMF did quote data that the real exchange rate has been appreciating for a few years. How does that, just can you outline for the, in plain terms, how does that affect the competitiveness of our exports?
Well, what it means is that costs in Jamaica are rising faster than costs in the rest of the world, competitors and markets. So what that means is that Jamaican goods are becoming more expensive. Producing anything in Jamaica is becoming more expensive relative to the rest of the world. What does that mean? That means that people who are exporting to the rest of the world either have to accept a lower margin and have to hope that, in fact, that margin doesn't go negative, or they have to stop exporting, find to turn to the local market, maybe, perhaps, or worst case, go out of business. So that's the simple math of it, really.
I guess, Joel, would you be able to paint a picture of what happens to your business in times of an appreciation against the US dollar, and what happens to your business, your demand, maybe in the instance of a depreciation, Jamaican exports getting cheaper versus getting more expensive?
All right, gladly. My picture will be different from other companies because every company situation is different. So I'm always speaking from a food manufacturing perspective. Now, when the dollar devalues, right, it affects a portion of the inputs that we produce or we import to produce a product. One. Two, with the sustained appreciation of the US dollar versus the Jamaican dollar, eventually all the things start to come into place, like utilities, even gas, so forth. Like, in other words, it incrementally affects our business, right? There hasn't been a large spike. I could say there has been a large jump that has made our company produce or make it challenging to produce a product as a competitive pricing. Now, with the initial increase, what happens is that because we sell in US dollars and we receive in US dollars, we benefit from that buffer. Because when we exchange it at a good exchange rate, then that allows us to cover us from the incremental inflation that we will experience eventually over time. So there's a timing of a buffer that happens. When that buffer is no longer there and the price of the local inputs and the effect in utilities and operational expenses increase because of the change of price, what therefore then happens is we have to then pass on that eventually to that consumer. And then we have to figure out, can that consumer be able to withstand that cost? But that is a buffer in time. That doesn't just happen overnight. It just happens with either a couple of months or even years, depending on the spike of the depreciation or appreciation of the dollar, right? The good thing is that our main ingredients that we rely on, they are not imported. They're grown in Jamaica. And we're able to lock in prices with our farmers and our local supply from our farms to be able to withstand the shocks of the depreciation. However, the farmers who are part of our supply logistics, they are in effect greatly affected because most of the fertilizers and stuff and the inputs into their farms rely on the importation of those foreign stuff. Even though they may be produced locally, there are some foreign inputs that are directly affecting. So for example, when we had the UK and Russia war happening, right? suddenly spike in fertilizers shot through the roof. And to produce that farming produce was significantly uncompetitive, and to be able to pass that through the consumer. So there are times when we had to say to the customer, hey, we're not able to produce at this time because our farmers are unable to produce, unfortunately. When the dollar appreciates, the Jamaican dollar appreciates, yes, there is a benefit, especially if we're selling, say, locally, and we're relying on local input. But again, there's a negative side where when we export it, the amount of cash return in exchange for that dollar value then becomes less. So there is a balance effect that has to happen within our company, our strategic partnership. So one of the things that we do is that we try to maximize the local sales, because that helps to buffer sometimes the fluctuation between the dollars, and of course to be maintaining some of our infrastructural costs to buffer back and forth. So I really hope that helped.
Okay, thanks.
Marian, this is one other thing and that is that there are a lot of distortions and inefficiencies in the local market when it comes to foreign exchange. And there's quite a wide spread between the buy and the sell. And a small, somebody going to a bank with a small amount of money will get a much lower rate than somebody who is a big, exporter or hotelier or something like that. And so one of the things I think that we do need is a more efficient market, so that there's less of a spread between buy and sell, and that everybody really is able to get the best rate for their currency.
So I suppose maybe that the IMF was making in terms of foreign exchange market deepening, maybe that's similar to the point you're making now. No, we have actually, I suppose I would like to ask yourself and Valerie, what would be the costs of ignoring the IMF's advice, deciding not to permit FX deepening or greater exchange rate flexibility, allow market forces to act? Can we think of the cost of that to us?
Yeah, so I'd like to echo what Charles said, that, I mean, if you can build a system where the foreign exchange market is more efficient, which has to do also with banking intermediation. Some of it has to do with the fact that it's probably a small market, relatively speaking, so you can't create that sort of depth that you would otherwise. But I think that it's interesting what you were talking about, being able to buffer some of these exchange rate shocks and things like that. A lot of the times people think that, if I'm an exporter, I only care about a depreciated exchange rate, right? But it's actually not true, because most of us have a lot of imported components. Right now, it's a very difficult time, because what usually happens when there's a lot of uncertainty is that, for example, the dollar tends to, that the currencies of Latin America, Caribbean countries, a lot of emerging markets tend to depreciate against the dollar. But actually now, because the dollar is depreciating against everybody else, we're seeing an appreciation, which obviously doesn't help sort of the direct exporter, while at the same time we may be seeing, due to perhaps tariffs or other issues, maybe some stubborn inflation, that some of the input costs are still high. So we're in a little bit of a difficult spot in that sense. Vis-a-vis that situation. But of course, there are other countries where the exchange, I don't want to say that there can't be improvements in Jamaica, but I think that there have been a lot of, that there have already been a lot of, a lot of transparency and a lot of reforms that have been done that have at least improved, I think, the foreign exchange market. So this is something to think about.
Okay, thank you. Going on from that, you've mentioned so many improvements and milestones we've hit. If you could select maybe the top 2 most impactful things for growth, that if Jamaica had to do, we've had all this stability but no growth, and obviously you listed a lot of things from the surveys, from what you've seen in other countries, but obviously no one can do everything at once. If you could choose the top 2 most impactful things that you think Jamaica could do to unleash growth, what would they be?
So I would say that there's a great opportunity right now in certain types of services. There's, first of all, I just want to say that, as you know, the world is changing very quickly. We have, for example, artificial intelligence, and we have, a partner that used to be quite stable. There's a lot of change, what they call reshuffling of global value chains, which sounds big, but essentially the idea that we had worked in a world order where there was, which was based in trade 20 years ago, and now we're moving to a situation in which we are sort of trying to figure out which are the sectors to go into. But services have a few advantages, and I think for Jamaica it's going to be great. First of all, and in fact we at the IDB are looking at these sorts of things, looking at logistics hubs, where you would have like a free trade zone in which you could have business services, call centers, human resource services, other types of things that that really take advantage of sort of the comparative advantage of the country. Tourism was also going to change, right? We have post-COVID, we have a lot of people working remotely. We have this new type of person called digital nomads. This system is going to change too, and Jamaica could position itself quite well in that regard. I know there's a lot of uncertainty going on right now, but within this repositioning of value chains, I would say one thing that Jamaica could do is to try to diversify its trading partners and try to look into something like, for example, logistics hubs in new types of services to try to really take advantage of those new digital services, that new technology.
Thank you. That's certainly something that is and services. Just maybe, and my last question on the economics to the panel would be, so Joel, you seem to have done a pretty good job of pivoting from a low value added product further along the value chain. You figured out how to have more local inputs to be, to support your margin. What, I guess, Charles, Joel, do you guys have views on what policies would need to be in place to create more exporters like yourself?
Well, what I would say, Marian, is that the one thing that we have resisted in Jamaica is allowing the market to set prices, or to set a very important price, which is our exchange rate. And, standard economic theory tells you that when the market sets prices, those price signals will direct investment into the most efficient areas of your economy. And that will maximize on the rate of growth of your GDP. And I think that part of the reason for our 50 years of economic stagnation is that we haven't yet embraced that idea. And so we have a bunch of people who think that they know better than the market, and they try to manage the key price signals. But in effect, what they've done really is frustrate the market. And because we have these periodic spikes in local inflation, it means that we have cycles where certain activities become attractive and profitable, but then over time that's eroded and we get back to square one, and those opportunities dissipate. So we don't really get a continued accumulation of output and investment in the key areas. So I think we really need to embrace the market theory of economics and embrace the idea that the market setting prices is going to give us the most efficient allocation of resources, and that will attract investments into the high productivity areas, and that will maximize economic growth.
One thing I would add to that is Jamaica is logistically positioned to allow for nearshoring to other regions. So let me just quickly state this. Because of the trade wars that have been happening over the past 5 years, 5 to 6 years, what's happening is that countries that are nearby is looking to import from their closest partners compared to their very distant trading partnerships. So with that, the economic and trade policies that Jamaica can take care of, can utilize more of, especially for companies or businesses or investors, is that we can say to, for example, other far countries who want to get access to America or LATAM or so forth, can say, hey, we can use Jamaica as that trading central hub partner to get to where my next destination needs to be. So, for example, there is a recent partnership, I believe, between Africa and with the Caribbean countries called with Afrexim Bank. And within that agreement, they are trying to partnerships allow for even countries within Africa to make partnerships with investments in Jamaica for regional and Caribbean growth. So things like that, if we are able to connect with that kind of partnership, we as Jamaicans are uniquely positioned to take more leveraged position in growth. So that type of policies and trade policies are very essential, especially in this type of time.
Yeah, it's a bit of a chicken or egg situation, because how do we become attractive to those people? Our prices have to be competitive, right? The cost of our labor, the cost of our of building and constructing the center here, everything has to be. And I guess that goes back to the point about the market forces, because if the market forces aren't setting the prices, they'll be artificially high, and no one would want to come and set a logistics hub up here. So I guess it's all related. One is the micro and one is the macro. But I think that was a great discussion on the macro. Maybe right before I open up the floor for questions, I just wanted to ask maybe Charles one last piece of advice for local investors. What investment opportunities would you say remain attractive in this environment for Jamaican investors who are seeking steady but also long-term growth?
Well, if you're talking about, again, fixed income investments, there's still attractive bonds out there. What we have seen over the last few months is really a gradual fall in yields, a gradual rise in prices, because there's a growing expectation that interest rates in the US will be coming down. And so, certainly, yes, the yields that are on offer now would be less than they were a while ago, but there's still a very wide variety of securities to choose from. And you can still earn decent yields in high-quality investments. And because interest rates are expected to fall, it certainly means that it's a good time to get into the market before that happens. Because as interest rates fall, the value of the securities will increase, and of course you've locked in your yield for the medium to long term.
Okay, great. Thanks, Charles. And does anybody, Valerie or Joel, do you have anything to add before I open up the floor to questions?
No, I think I very much agree with what you mentioned about trying to find opportunities for Jamaica to take advantage of this, being where it is geographically, I should say.
That's true, yes, for sure. That's a big topic. Thank you, guys. Michelle, I think, do we have a mic roving for questions? Oh.
Hello, etc.
Well, I think in general, we need more development banks, not less. I remember we received a similar question. There's another bank that, as you know, is the Asia Infrastructure Investment Bank that was open at the time. And somebody asked the Asia Development Bank, are you worried about the competition? And they said, no, we have no competition. We're a drop in the bucket. And I think that would be true also for IDB and other places. Development finance is even more needed now. Certainly the world has changed, and with development finance usually comes knowledge, technical assistance. So, the more the merrier. I don't know much about the bank myself, but I think that that is something that we have the development banks have been able to diversify a little bit. They all have different structures, and I think that they will continue to be important.
Thank you.
We're seeking. As Marian would have highlighted, we have certainly over the last decade proven that we have been able to maintain some of the types of monetary policy, fiscal discipline, things that I would say make us attractive to foreign direct investment. But in your experience, how does attracting foreign direct investment help us grow or help us to achieve the growth targets?
Right, so as I mentioned before, I think an absolute necessity, the first thing you need is macroeconomic stability. Without that, nothing's going to work. Even if you have nice roads, it's absolutely essential. So in that sense, I think Jamaica has done that and is showing the world that through this fiscal consolidation, it is serious about doing business. It's raised its institutional quality. We know, for example, in a lot of indicators like government effectiveness, which is a very important indicator for attracting FDI, Jamaica has really gone up in ranking in that sense, and in other indicators as well. So I think everything is that fiscal consolidation is happening. Of course, that has to continue. That it doesn't mean that you're sort of done it, but all the effort has been done. The big the bump in the road of really pushing to get this has been completed. And so I think the next stage, at some level, not that I want to say it's any easier, but it certainly we want any. For example, you can do some of these things like creating a foreign direct investment office that can start attracting, trying to find out from other sectors, from other countries, what are the kinds of things that work for setting up businesses for where there could be a comparative advantage. How you can take advantage of all this uncertainty. Nobody can take advantage of the uncertainty, but certainly with all these changes that are occurring in the world, there are always opportunities. So I think that one can go into detail. Having a stable tax system, ensuring that when an investor comes, they know that they will be able to, they will have, that the tax, whatever the taxes that they were offered at the time, they will continue to be there, and they won't just change them from one day to the next. So stability and reduction of uncertainty is absolutely essential. Yeah.
Thanks for that. A jam pro around for some time. But.
No, well, I think it has been. If we look at the tourism sector, I mean, almost all of the hotel developments that have taken place in the last 10, 20 years have been funded by foreign direct investment. The strange thing is that we've actually had a fall off in the rate or the size of annual FDI inflows in the last 5 years. I don't know if that is a post-pandemic issue or if it is tied in with domestic macro policy. But for sure, we're a poor nation. We don't have a great deal of capital ourselves. So FDI will be important to the growth of our economy.
Thanks. So I have one question coming in electronically. I'm not quite sure how to read it. So apparently there was an article in the Financial Gleaner, according to this person asking the question, I haven't read it, where the author wrote, Stephen Marian, the chair of Trump's Council of Economic Advisors, has been nominated to serve temporarily on the Fed Board of Governors. He has proposed forcing foreign investors to convert the U.S. treasuries they hold into 100-year U.S. bonds without coupon payments. I'm not sure if this is 100% factual.
Have you fact-checked?
I have not. He has just sent the question.
It was in the Gleaner. It's a statement from a gentleman.
Okay.
Blackman, I think.
Right. Okay. Well, I don't want to quote Mr. Blackman without having read his article myself, but I would say, is that familiar to you, Charles, on the panel? Does that sound familiar? No, we probably have to get... Huh?
No, but what's the question?
Would this spell disaster for the U.S. and for us?
Well, I don't know how many U.S. treasurers to behold, but I don't think it would be very good for the U.S. economy, for sure, or the U.S. financial market. It would be a disaster.
Great. Well, I think we have time for one more question, and I see one hand in the audience.
Question is, will there ever be a time that's okay enough to look over to that venture? Because this is a conversation that I've heard many times, and the concern has always been the same. So whether past, future, or no, was there any time that any of the panelists, in your opinion, that was the time for that type of investment? Considered this as an option. The barriers that were mentioned included logistics and all of those side of things, which I agree with. But I'm saying that will always, as far as I'm concerned, every time I've heard that being brought up, that's always the concern.
Yeah. So I'm not, but I mean, that sounds like a whole panel discussion in and of itself. And I know the CARICOM heads of state were here trying to crack some of those problems. I don't even know if they solved them while they were here, but Charles, I don't know if anybody.
Well, what I was just going to say, Joel, don't you export to the Caribbean?
We do. Yes, we do. Yes, we do.
So it's happening.
It's happening.
Okay.
Yeah. Okay, I think I have one more honorary question over here.
It seems like the U.S. is just dominating the world, so I don't know.
That's a great question. We've gotten a lot of that question in 2025, actually. Both Charles and Valerie, would you like to comment on that?
We're moving into a world in which there's a lot of uncertainty, and that's we've always felt that the U.S. dollar has been a stable currency for so long, and so I have no idea. I doubt it's going to happen in the short term, but that's I don't know the answer to that question, but it's a very good question.
Yeah. Charles.
I lose some of its currency, some of its attraction as a reserve currency. But I agree with Valerie, it's going to be a long time before it's quote-unquote replaced. But I think what we will see, other currencies becoming, perhaps taking a greater share of central banks around the world in terms of their reserve currencies.
Yeah. Okay.
And for China or India to come up.
Yeah, very uncertain times for sure. Yes, so thank you everyone from the audience for participating. I'm out of time, Michelle. Am I at my time? Okay, I won't ask any other questions then. But thank you everyone for coming. This brings an end to our official panel discussion. And I would just invite our team to come and give some tokens of appreciation to the panelists. Thank you everybody.
Marian, so we're just gonna share some tokens of our appreciation to our guest panelists, Joel and Valerie. So Christine Rankin, our AVP. First we'll start with Valerie.
Valerie battled a lot of our good Jamaican traffic to get here with us, so we thank her with all our heart. Thank you, Valerie.
Thank you so much.
And also for Joel Harris. Thank you very, very much, Joel, for participating with us this evening.
Even Joel out. Joel had the football match, but because he really wanted to. Thank you.
No problem. Thank you so much.
Wrap things up very quickly so we can all get to eating and talking some more with each other. So, on behalf of Sterling Asset Management, I want to extend heartfelt thanks to our moderator, Marian Ammar, for so skillfully guiding tonight's discussion, and to our esteemed panelists, Charles Ross, Valerie Mercer-Blackman, and Joel Harris. A special thank you to our partners, Soini Miller and Tamara McPherson at DRT, Stephanie Hazel at Engage Media, and Terry Anderson at Dunlop Corbin Communications. We're all here this evening. and also Diana Buchanan at Nationwide News for helping us to bring this event to life. We're deeply grateful to our Sterling team, Eugene Stanley, Tony and Nita Elliott, Anna Joy Tibby Bell, and Christine Rankin for their tireless work, and to Tricia Knott and her team at Knott's Landing for the beautiful setup that you see here this evening. And also appreciation to our photographer, Horace Freeman, who is captured this evening in photos. And most importantly, thank you, our guests, for joining us. We look forward to continuing this journey of insight and opportunity together. Have a wonderful evening.
Okay, well, one of the things that we do is that we really keep track of developments in the U.S. economy and the global economy in general. And what we do is that we look at the trends that we expect in interest rates especially over the next year or two. And basically we try to position ourselves to benefit from those developments. The other thing that we try to do is to keep some powder dry so that in the event that there is a major fall in the market, we're able to cherry pick, to step in and get securities at good yields and good prices. Well, the biggest risk really is a significant fall in economic output, a recession. And in the US economy and in the world economy in general. And unfortunately, that is a very strong likelihood. Of course, as a small country, very close to the US, it's one of our major trading partners, it's the source of most of our tourists, then a fall in the US economy could also affect the Jamaican economy. Our economy could also go into recession. The other thing that a recession might do is it might also affect the profitability of companies, and that might affect, of course, the quality of the bonds that they issue. So a recession could impact the credit quality of the bond portfolios that clients have, and it could also affect bond prices. Well, the opportunities also will come with that because it might mean that market sentiment will change, that there will be a sell-off, securities will be going cheap. When that happens, the market is usually not very rational. You know, it's like everything goes down, even stuff that's good. And so in those dips in the market, there will be opportunities to make investments that will deliver higher yields and good returns for the medium to long term. Well, what we're really trying to do and planning to do is, of course, celebrate our clients and express our gratitude for their support over the years. We're also looking to position ourselves as we've done in the past. One of the things is in 25 years, you see a lot of crises. Big ones, little ones, short ones, long ones. And so basically we are positioning ourselves conservatively so that we can weather the storm and also be able to take advantage of opportunities. And of course, we'll make sure that we put those opportunities before our clients as well, you know, so that they can take advantage also.
Okay, great question. So I think there are three really important things that investors need to focus on in this environment. One is the credit quality of the investment. So they need to make sure that whatever they're getting into, those companies, or whether they be stocks or bonds, are well positioned to manage the market volatility and the economic uncertainty that's kind of persisting right now. So we tend to focus, the practical step translated to that is we tend to focus on investment grade rated issuers who tend to be fairly large, well-established blue chip companies. There are some anomalies in what we call high yield, which is below investment grade, right? Maybe one or two rungs below, where we think there is decent value for for investors with higher risk appetites. But certainly we think that choosing the best of any category you're in terms of credit quality, assessing the credit risk, is a really important step. And credit ratings are a pretty good guide to assess that credit risk and find yourself along the spectrum. The second step, I would say, ensure liquidity. Make sure that you're going into an investment that you can exit within a reasonable period of time. I think it's really important for your advisor to be transparent about that. Typically, we focus on the global markets because those investments are super liquid. The instrument sizes are a good indication of liquidity. Anything above 500 million US is typically a pretty decently sized issue that you should be able to get in and out of. So we tend to focus on liquidity. And the third thing I would say for investors is that they really need to take a longer term time horizon because in this environment there's bound to be a lot of volatility. Prices are up now because of tariffs and a lot of other economic uncertainty. We don't know that prices will still be up next year, even if the Fed cuts. It could be a shallow path, it could be a longer path. So the most important thing is not to panic when prices go down, as long as you're in a good quality investment that you're likely to be repaid your principal. I think it's important to be patient, take a slightly longer term view because of the volatility, and add consistently because that will help you ensure that you're not just buying at a peak or buying at a dip. Timing the market is really hard for anybody, we have a saying that time in the market matters more than timing the market. So definitely the longer term horizon you take, the more likely you are to earn the return on the index or on the investment, the historical return that you're earning, and not selling at the bottom and just adding consistently so that you have a good average price. So I think definitely we are pivoting to a lot of new strategies at this time because the environment has changed so dramatically. We're exiting a high interest rate environment of last year coming down. Last year we started coming down, the interest rates started coming down, so it made longer dated bonds, for example, a lot more attractive. So before we were showing our clients one specific type of security, and now we get to show them a slightly longer dated security with different features and potentially more attractive yields. So those have become more attractive over the last few months, and we anticipate more longer dated issues coming to market and us being able to bring that value to clients. Certainly our mutual fund is up 7.5% year to date. That's over a 14% return annualized, and we do anticipate that as interest rates fall further, that product will continue to rally and do well. So that is a solution that I think many investors can benefit from, whether you're saving for college or saving for a pension, retirement, even a home purchase, young, old. Most people benefit from this product. So certainly we think it's a great opportunity. We're using the change in the market to amplify the investment strategy and of course deliver those returns to clients. In terms of new instruments, certainly it's not so much new instruments as new strategies, because the world is changing so rapidly and there are sell-offs in what we call maybe firm-specific opportunities, companies that maybe were out of favor but are generating good cash flow and doing well. Companies that are being turned around, and we see some pretty good pockets of opportunity in Europe and in the US at the moment. So we're excited to tell our investors more about those. Thanks. So it's awesome to have our clients and investors and just thought leaders here this evening. It's a great discourse we're having. I think it's of national economic importance, the conversations we're having. We want to figure out how to make Jamaica grow. We want to figure out how to get our investors more wealth, to accumulate more wealth. We want the country as well as our investors to be better off. So it's always a stimulating discussion. It's something that we've done every year for the last 25 years, and it's always reassuring. It's always a pleasant surprise to hear people ask questions, really hard questions. I think someone asked today, is the U.S. currency still going to be the reserve currency? And I think these are questions that affect everybody. And so we love the discourse. We're passionate about it. It means a lot to us to be able to have a platform to discuss these issues and to have people engage with us on them. So that would be one. In terms of what it means to be turning 25, I was saying to someone, I've been here for 15 years of the journey so far, and I think it's been a really, really fun and rewarding ride, really, really hard. There have been highs and there have been lows. Emotionally, not, of course, from business, we're going from strength to strength. But, anybody that's been in business for 25 years would have withstood a lot of crises, many different crises. And in fact, I think crises have just completely characterized our history. We were born in 2001, and then, of course, the 9/11 happened right after. But as a result of that crisis, new securities were issued, and we did really well in those securities. And then, we had the Ponzi schemes, and I actually told this story recently that in 2007 we lost 70% of the funds in our mutual fund to the Ponzi schemes, and that same fund is up over 800% today. So I think there are a lot of themes of crisis is here. Our big theme is like kind of turning crisis into opportunity, in that we've been through a lot of crises. 2008, 2009, most of our clients actually did really well in that crisis because prices were so low and deals were so great. So we've at each point turned something hard into something really great. But at the time you're going through the really hard part, you don't know how it's going to turn out. So I've definitely gotten some gray hairs over the time, but it's been a very, very rewarding journey, and doing it alongside our clients and withstanding the crises, benefiting and profiting from them, and kind of just learning to ride the waves and enjoy the journey. So it's been a great. It means a lot to us to be turning 25, because kind of when you're in the day-to-day of your business, you're just fighting and growing. But it feels very rewarding, and we're so happy and grateful that we've grown and evolved to this stage, and our investors have come along with us.